It's an honor and a privilege to have Cody and Brian on. Guys, how you doing?
Good, Gino. How are you?
Doing great. Take it
Uh,
away.
Thanks for having us, guys. I tell you, it's kind of hard to follow Joey DTS over there. He's got us nervous now.
Uh-huh.
Hey, you just bring a nickname to the table and you'll be fine.
Oh,
Well,
we
Jake's,
got a few.
Jake's got the Miyagi-sana. He's got the karate thing going on, so you guys better be careful.
Love it. Love it. Appreciate you guys having us again. Honor at this opportunity. You know, when you join groups like the Wheelbarrow Profits community, you look forward to opportunities like this. So definitely super excited. Tonight, I'm here. Cody's here. Our third partner, John, unfortunately is not here today, but we'll spend a few minutes introducing ourselves. Cody, you want to talk a little bit about yourself?
Yep. So I started my real estate journey in 2010 after becoming an accidental landlord. Unfortunately, around that time as well, the great financial crisis, we were just coming out of that. And I was just starting my W-2 career, watched people around me getting ready for retirement that just were in panic because they couldn't retire. And, here it is. I'm trying to learn how to invest in retirement assets. I'm an accidental landlord, and somebody introduces me to the Purple Bible, right? The Rich Dad, Poor Dad, and the light bulbs went off, and I was like, "Holy shit! Everything I've just learned in my entire young adulthood was totally incorrect." And so, started real estate entrepreneurship. Spent some time in single family. Did a couple other business ventures that didn't pan out so well. Learned a lot. Learned a lot of expensive mistakes. And then ultimately made the transition to multifamily in 2019, right before joining Jake and Gino, along with John. And fortunate enough to had met John while working on another partnership. And then we met Brian midway through last year, and then here we are. So,
Cody, don't leave out that you're a licensed skydiver now.
Yeah, so I'm a little bit of adrenaline junkie. So I used to ride crotch rockets, as we called them down here, but street bikes, and that was a lot of fun. And then traded that in for skydiving. So I love jumping out of airplanes. It's fun.
Cody, I'll give you $1,000 if you can get Jake to jump out of a plane. $1,000,
Dude,
you heard it on CC3, bro.
You better get more money. You better get more money than that, man.
And then $5,000 after party.
I can't get him on a plane, let alone jump out of a plane. So just saying,
you're not even in the ballpark right now. Okay.
Challenge accepted.
Bro.
Awesome. And our second partner, John, who's not here, who some of you might know, John Beatty, he goes by Crypto John. His fun fact that he likes to make sure he lets everybody know is that he actually grew up in the Tennessee area, not too far from Nashville. And his family is pretty known in the area, the Beatty Farms. They're pig farmers. And he likes to tell this story if you ever meet John, but his family actually raised Wilbur the pig, which is the pig you saw in Charlotte's Web, the movie. So
delicious.
If you ever meet John, ask him. He's got some interesting stories about that. For myself, Brian, born and raised Houston, Texas. You'll see here it says I'm a coffee connoisseur. So what I do also, along with real estate, is I have a couple of specialty coffee shops here in the suburbs of Houston, Texas. So me and another partner of mine, we have two of those locations, hoping for a third here soon. We opened that back in 2017. I started my real estate journey in 2000.
Are there going to be apartments above the next one?
That's the goal, right?
Little mixed use action, not yet?
Yeah.
Okay.
Not a bad idea. But I started my journey in 2018. We talk a lot about mindset in this group, and I had a very limited mindset at the time. I was using a very simple formula. What do I have in my bank account? What is that 20% of? And that's all I can buy. I was learning a little bit about hard money, a little bit about private money, but really was thinking really small. We like to say in our group here at Blue Oak, think big. It's not, if you have a challenge, it's not, what do you not know? It's who do you need to talk to sort of overcome that challenge, right? So I did that for about a year and a half, kind of checked all the boxes. I got my realtor's license. I did some wholesaling, did a few flips, picked up a couple of rentals. But after doing that for a while, I realized that it wasn't the best business to match my personality. I still think single family can be a tremendous wealth building tool, but I was looking to do something bigger. I have a business background, business degree, and really wanted to scale a business. So I started looking at multifamily because that was a 5-year goal anyway. And even though I was only 18 months in real estate, I said, why not? Why not right now? And COVID actually hit around the time. So it sort of became a blessing in disguise, forced me to slow down, think a little bit more, ended up networking and meeting our first partner, my partner, John Beatty, and started asking questions about the group. Eventually ended up joining the Wheelbarrow Profits community in, I believe, July of 2020. kept networking with John and Cody. And then, I was very lucky, very fortunate enough to be invited to join their partnership over at Blue Oak Capital. Felt like I brought some skills to the table that they really needed to grow their brand and grow their platform. And as we like to say, here we are. I wouldn't say the rest is history yet, because we're just getting started, but we're making some trying to make some big things happen and make sure we stay movers and shakers.
So before you get to the next slide, you can jump to the next slide. But my question was, do you think the academy, the community, the partnership shattered that limiting belief? Because you're on that path of, like you said, 20% down. How do I scale up? I have 2 coffee shops. I've got so much work to do. I don't know how to do this all at the same time. I don't want
not enough Brian to go around there.
Yeah. Yeah, I think it definitely did. A couple of things that were definitely mindset change was one, pretty early in the journey. Get a little shout out here. I got to talk to Marco, I think before I joined the community actually, and I was hearing about all the things he was doing, and he was talking a lot about mindset, and I was a big mindset guy already. So it sort of threw some fuel on the fire. And then while I was, trying to join the group and going through the process, I was speaking to a lot of students, and I was really realizing that the people that are buying these buildings, these, 10 units, 100 units, whatever, 200 units, they're just normal guys. They're people that have jobs. Most of them all of them start with 0. We all start from 0 units, right? It's not like you're born with 100 units, most of us at least. But so I was realizing that it's really all about mindset and getting into the community and connecting with other people, being surrounded by like-minded investors was really motivational to me and really helped me along on my journey, and still does to this day.
So many people struggle with, it's this pie in the sky. It's not for me. What's going on? Because it takes a little while to get into it. It's a fantastic point.
So, Brian, you also taught me an acronym that I'd like to share with everybody. I'd like everyone to write this down. It's ROE, return on effort. If you're out there, you're doing a 4-plex or an 8 unit, why not do an 80 unit? It's basically the same amount of effort. It really comes down to mindset. You need to have the accountability piece. You need to have the teamwork, but think of the return on effort when you're doing a smaller deal as opposed to a deal that has another 0 in front of it. It's the same thing. Always focus on what kind of effort you're putting into the deal and seeing, does this make sense?
I challenge that right now.
Challenge me.
4 unit is going to be harder because you're going to be cheap and you're going to start doing more of the work yourself and thinking that you're going to go in and do the plumbing. You're going to take the phone call. The 80 unit is going to have people supporting you and doing that and filling in the gaps. The 4 units can be harder.
That's a great point. Thank you.
Thank you. I'm
Love
done.
that.
100%. So we're excited, Cody. I want to definitely make sure we get you in here, but we're excited to talk about this because Cody's the one who really fostered this relationship. We've learned that the name of the game, especially in these larger assets, this first deal that we did was 240 units, was all about partnerships. If you're not going to be willing to partner in this business, you're not going to get very far. It's just kind of you learn that very quickly, because at the end of the day, not only do we all run out of money, but we all run out of time. And the more and more assets you continue to pick up, even if you're buying 10, 15, and 20 units at a time, you're going to eventually run out of time in the day to manage these assets or to manage the manager. So the name of the game for us was definitely scalability. And we've learned that partnering is crucial. So I want to give Cody an opportunity. Cody, talk about how this relationship started to form and how we got into this first opportunity, because it was before I even joined Blue Oak Capital that you got connected with George.
Yeah. And going back before we get on that, first off, hey, Brian, you mind switching off the presenter view to the presentation view? And while you're doing that, Gino,
you never know what kind of notes people put in there for themselves. Like, we don't want to scare anybody. You know what I'm saying? I know I put some weird shit in ours. So,
but let me even before you start, Cody, what I love about it is, I love about it is on the first one, deals doing internally, right? You're vertically integrated. On this Prezo we're talking about right now, what you guys are doing, it's syndication. So learning all of the different strategies is very important. If you want to do a 4 unit or 8 unit or 10 unit, nothing wrong. Learn how to do that. If you want to get into bigger deals, learn syndication, because the more tools in the toolbox you have, the better the ability you will to find the deals that fit you. So if you can creatively finance a deal, if you can JV a deal, if you get to take a deal down by yourself, if you can syndicate a deal, if you can learn all of those strategies, it will allow you to be able to look at more deals and make more deals make sense to you. So
yeah, absolutely. I mean, look, as you're getting started in this space, you're only limited by your own beliefs and your own network, right? I mean, if you want to go big, you can go big. You just got to go find the network and the resources to do it. And that goes back to your point, Gino, you were making earlier about, the community, and being a part of a mentorship program in a community like this is finding other people that are like-minded, that share the same alignment of interest, and tapping into that network, so you can expand and you can reach for the sky, so to speak. And so that was the biggest benefit of here, is just joining a community that had the right abundance mindset and culture. But and then that same thing leads us into the principle of the relationship building, right? And so going back to this opportunity, when you talk about syndication, it's very hard for a first-time syndicator to get in their first deal, because it's all about your credibility, right? It's about your credibility with your partners, your credibility with your investors, and also the credibility with your brokers, right? And so one of the ways that you can hedge against that lack of credibility is partnering with other experienced operators and leveraging their track record and leveraging their experience. And so I was fortunate enough to have met George Abreu with Elevate Commercial Investment Group. He's the lead sponsor on this particular deal. Met him back in 2019. And at the time, he was really kind of up and coming. He was doing some pretty big deals in some of the markets we were in. And so just started following him, watching him, and was engaging with him on social media and just different forums, connecting at any opportunity we could. And early 2021, we were working on a deal here in Houston, and it was in North Houston. It was the first deal in, couldn't tell you how many deals that actually penciled out like perfectly, right? We did the tour. We asked the broker after, like, all right, tell us what the price guidance is. And he told us, and it was exactly what we underwrote to. And we're like, holy snap, like, here it is. We got
it happened. The stars aligned. It's real.
Fell in my lap.
It's a great
We were in the
feeling,
car,
isn't it?
Cody. We were both looked at each other like, is this it?
Is this it? Yeah, that's right. But then we also had a reality check too, that it was a value add deal and it was a $9 million raise. And we were both like, well, we know we can't raise $9 million yet. So what do we do, right? So we started tapping into our network of other experienced operators, including Jorge Abreu on this particular opportunity. And long story short, that deal didn't work. But what it did do is open up the door in conversations for, hey, on your next opportunity, if you have something, can we partner with you, and vice versa? And so, and what we knew, and Brian was alluding to this earlier, is through COVID, we spent a lot of our efforts during COVID really expanding our database, really doing a lot of networking with both active and passive investors. I mean, we 4x'd our database through COVID. We stayed busy. We got our podcast going, meetups. We're back in shit,
I remember like back in the summer, you guys had like a LinkedIn strategy or booming, right? You guys were hustling.
Yeah, we had the social media strategies going, again, the thought leadership platforms. And I say all that to say is what that did, all of COVID really allowed us to position ourselves to add value by way of bringing equity to a particular deal. We were underwriting our own deals. We were out there sourcing our own opportunities, but we were having trouble finding the right opportunity. So along comes Jorge Abreu. We approached him back in February after our deal in January and said, hey, we'd love to partner with you again. And he said, well, great. I've got a couple acquisitions under contract right now. Here's a couple that you guys want to take a look at. So this was the one that we was presented. And he said, look, if you can bring some capital to the table, we'd be interested in take a look. And so we put a bold commitment out there. We said, okay, we're going to raise $1.5 million for you. And, to be a part of the deal. And it was in Houston in our backyard. So we really liked the opportunity. It was a textbook value add, first generational value add opportunity, which it's hard to find those unless you're Joey DTS going direct to seller.
It's harder on the size too, Cody. 240 units that hasn't been traded and hasn't been touched in 25 years.
A lot of people drilling on that, right?
Yeah, it is. Yeah. So it was great. So he had it under contract, and we made that commitment, and we got to work, right? So we started putting to work. So this was a 240 unit, 1979 value add deal in North Houston. Unique floor prints. It had both efficiencies, 1 unit, 2-bedroom units. And all of the units were roughly around 680 square foot. So your smaller size units, which was not uncommon for your 70s product, right? But what was unique is the way the floor plans were laid out is it allowed the opportunity to take the efficiencies and convert them to 1-bedroom units. And they had these 1.5 bedroom units that you could literally slap a wall up, call it a 2-bedroom unit, and then capture another couple $100 in rent. So total purchase was about 18.
These like New York City size apartments with like 4 square feet, or what are we talking about?
On paper, what's interesting is they look small, but actually the layouts actually weren't that bad. So when you walk through them, you don't feel like you're in such a small cubicle, which was interesting. But
way to be an optoptimist, Cody. We love it.
Hey, you got to look at the bright side, right?
That's
Glass
right.
is always half full. So.
That's right.
$18.6 million purchase price. And the beautiful thing about this was also the market timing. So this went under contract contract in January of 2020 or 2021, excuse me. And everybody knows just how much appreciation we've seen this year, right? So we're already positioned currently in the market right now to trade this at our 5-year projection this year if we needed to. So just, give you some perspective there, what we see in the market.
So what's the prepayment on it then? If you decided
this is bridge. So this is bridge. Yeah. I'm
bridge,
getting there.
gotcha.
Yeah. So this was
sorry, I'm doing the Gino. I'm backing up.
Don't be Gino, Jake. Gino's just one's enough. Okay, bro.
No, it's all good. So this was a heavy value add. Again, this is a long-term owner, 25 plus years, self-managed.
I think he was a doctor too, right, Cody?
As a doctor. Yeah. Doctors.
What's the common theme tonight? We got hustlers, buying from doctors and lawyers. Yeah. Boom.
Hey,
we're done.
It's a magic recipe. There's the magic formula.
That's the secret, folks.
But doctors, man, they're great taking care of patients, but sometimes they're not the greatest at taking care of their properties, right?
They got to be on the LP side.
Yeah, that's right. Yeah. Mm-hmm. So this one, he kind of kept rents extremely low to keep occupancy very, very high. So we took it over. It was about 95% occupied, but average rents across the entire community were about $550, which if you know anything about an MSA like Houston, that's a rare.
They're giving it away. Yeah.
Average market rent here is almost $1,200, just for context.
Just give you some perspective. Free. Yeah. So it ended up, again, because of the value add, it was a pretty heavy lift. We committed.
It had to be full, right?
Yep. 99%. Right?
Yeah. 99%. Yep. Yeah, so it was $3.8 million CapEx budget. So that equated to be roughly about $9,000 per door interiors and an additional $6,000 for exteriors. So top to bottom, heavy lift, renovating every single unit and every aspect of the exteriors. And that put our equity raise about $5.6 million. So, our business plan of this one going in was to really, like we said, we were going to renovate every single unit. We were going to do some of those unit conversions, the efficiencies to 1 bedrooms, 1.5 to the 2 bedrooms. We were going to add some things like covered parking, things like that, and then start capturing some of the other income fees that the previous seller did not. He was just slumlording this thing really. So cleaning out the tenant base as well. There was a lot of tenants on month to month.
44 to be exact.
Yeah. So just kind of cleaning up the tenant base and kind of resetting the demographic, so to speak. But the other interesting thing about this too, the thing that made this really, really appealing is the proof of concept. So our lead sponsor, George, this is one asset of 3 on the same street. George also has ownership interest in the property directly across the street that they had just closed on prior. Similar vintage, similar style of community, and they were already capturing $200 to $300 more in market rent above what we were in place on our actual. So it was an immediate proof of concept going out the gate. So we projected this on a 5-year hold again, because it is a value add play. We did go bridge. So we got a 2-1 structure. That's 2-year term with a 1-year extension, fixed interest. And then because of the upside potential in this one, we went with a straight 70-30 split.
It's got a refi year 3.
Year 5, re3, and then an exit after 5 years. So if you look there, our 18% cash on cash return, 20% annualized return, and a 2x multiple. When we first put this out there, people would reach out to us and they're like, "Hey, I think you got a mistake on your cash on cash.
You got an extra 1 in there.
You got an extra 1 in there." And we're like, "Nope," because it had so much upside potential because of the way it had been operated.
Oh. Man, 240 units with that kind of upside. That is beautiful.
So Cody, speak real quick about what a 2x equity multiple is to the people who don't know.
So essentially, the basic easiest way is you're doubling your money in 5 years, right? Mm-hmm. And that's including your equity gain and your cash flow throughout, right?
And the bridge financing is 2 years term. It's non-recourse, correct?
Correct.
So, and then it's an additional year on year 3 if you need it to bridge it to before you go bring it to agency financing. Do you know what the rate was on the loan?
Yeah, we ended up coming at like 4.15. It was like just barely over 4%.
All right, awesome.
Yeah, so pretty attractive at the time. Bridge wasn't quite as aggressive then as they are now, but still very attractive terms given where we're at in the marketplace. So
love that. Let it rip.
So I'm disappointed Brian changed a picture on me here on the slide because
I did.
The old picture showed like the original vintage and this thing was like it needed some love. And so this picture that you see here, this is actually after
Shaker beige. Yeah, the shaker beige kicking, right?
Yeah, it was pretty rough, but this is one of our turns. So we did, again, new flooring, paint, two-tone paint, resurfaced countertops, new cabinet surfaces, handles up, black appliances and things. And man, you should, our walkthrough, Brian, you remember our walkthrough?
Yep.
Like some of these units were like had long-term tenants that just piecemealed their repairs. The tenants did their own repairs, and like it was
Trading
so
cabinet doors with one another. Yeah.
Oh yeah.
You take my range hood. I'll take this. Yeah.
The dishwasher outlet had a
they had shelves and
piece of plywood. Yeah, piece of plywood's covering it to make like a door for extra cabinetry. It was really kind of janky.
It's innovative.
Oh yeah.
So tell me again, you did cabinet door replacements, or you painted the cabinets?
A lot of them we just painted. The ones that were salvageable, we just repainted. The ones that needed replacing, we did. But most of them were in pretty.
The ones that need to replace, you just did all new cabinets.
Yep.
Let me jump into this. A couple of questions here. Caleb asked, what benefits they're doing bridge compared to getting loan term up front? You're basically doing bridge because this is not financeable probably to the agencies because the NOI is so low, even though there's an occupancy.
50% LTV, they'll take it.
Yeah, that's what I'm saying. So you need to come up with. Plus, you're getting a lot of your capital for the capex.
That's the kicker, right there.
Financed in there, so you're going to own more equity on the deal.
Yeah. So a couple of things you need to know about the capital markets. So with agency debt, number one, Fannie and Freddie are only going to look at your actuals and your financials. So they're only going to look at previous actual performance. They're not going to look at future value add projections. Mm-hmm. So that's the benefit of going bridge, is because bridge will look at what does the pro forma projections look like and base their valuation or their debt on future performance. Okay. The other thing too is agency typically will not go above your 70-75% leverage. And so you can roll in some of your CapEx costs into that, but your bridge lenders will kind of, just depending on the deal, may actually give you up to 80% leverage. And then in addition to financing most or all of your CapEx costs. So it kind of allows you to lever up a little bit, which helps you on your capital raise. And then plus you're basing your loan off of your future performance and these upside, which is important when you're doing these value add deals.
And last question here before you go to the next slide. Do you do a cost seg at closing so that you can take bonus depreciation, all the stuff that will be thrown out during the rehab in year 1 or year 2? So cost seg was done on this deal after you closed, correct?
Yeah, it's going to be year 1. So with cost seg, you actually there's an extended timeline in which you can actually initiate your cost segregation study. It doesn't have to be immediately after close. Mm-hmm. You can do it up to, I think it's 12 or 18 months after you actually officially close. Before getting your cost seg study. But yes, we are doing it year 1 this year, and we're capturing, Brian, 80%, I think, bonus depreciation.
Almost 80%.
Yeah.
Mm-hmm. And this was roughly what, 80% loan to cost? Is that what you said?
80% loan to cost. Yeah.
Awesome.
Yeah. And for some context, y'all, I pulled the original rents just for fun. The efficiency was getting 536 when we took over. It's now getting 780. The 1 bedrooms were getting 556 and 616. They're now getting 810.
What's up with these sixes?
No, what?
536, 516. What?
Those are original rents.
Yeah. Why was everything in the 6?
I don't know. That's a great question.
Hey, it's making money. Who cares?
Yeah. The 2 bedroom was getting 625, which is not a 6.
Gosh,
the first
that's
one.
really
it's now getting 1,075 on a renovated.
Boom.
Yeah, that is awesome.
Yeah.
Awesome.
Yeah.
So it looks like you have a potential buyer here. Are you leaving any meat on the bone? I only see a little bit of that coming through if you want to sell.
Yeah, absolutely. I mean, I think
of course we are.
I mean, look, the ideal scenario is you can exit prior to either your holding period or prior to having to execute your full CapEx budget, right? And so ideally, and what we've actually experienced is we have a lot of residents that want to stay in place just because they see the impact from new management. They see the renovations, they see the management and the presence. And so a lot of them have renewed without even turning their units at the new market rates, just because they're happy with the changes they've been seeing. They're no longer living in a slumlord community, or they won't be for very much longer, so that's good too. So we're actually hopefully going to save some CapEx dollars as well, because we're not going to have to renovate every single unit as we originally projected.
Love that.
What was the median income for the area?
So this one was a little bit low. So we typically target markets that are about $40,000 household median income. This one was kind of about $35,000 for the area. It is a workforce demographic in this location. But, again, one of the things that allowed us to kind of overlook that was the proof of concept with the assets across the street that were performing much better already. So.
Yeah, and to kind of move on and talk a little bit about target market fundamentals, we really like this deal because it's actually uniquely situated around a business park. There's an area around it called the Pinto Business Park. Great name. But it's got, this is literally like walking distance. It's got Amazon, it's got Coca-Cola, it's got a lot of Cisco, which is a food supplier. It's got HD Supply, which is another supplier. There's a lot of jobs in the area for people to walk to. And there's also easy access to things like the airport and other major job centers, major highways, 45 that takes you straight to downtown. But from a population standpoint, talking about major market fundamentals, we definitely try to look at markets that are at least 150,000 people or more with positive migratory patterns. Houston is obviously one of those MSAs because there's way more than 150,000 people here. Secondly, from an economic standpoint, kind of what I was alluding to, we definitely look for markets that have employer diversification and growth trends with jobs. So Houston is known as energy city. Everybody knows it's an oil and gas city. But we've also done a pretty good job, I'd like to say, over the last 20 or 30 years since the last crash, I think that was in the 80s, of diversifying our economy. We've got definitely major employers such as the Med Center. Houston has one of the most well-known cancer research institutes here in the city. And also we have other technology companies that are starting to come in. Places like Austin are getting really saturated. Places like Dallas are really saturated. So people are starting to look at other markets like San Antonio and Houston. So we're starting to see job growth, which really, for us is something we monitor very closely and something we're very happy about. From an unemployment rate standpoint and demographics, Cody already kind of alluded to this. This is a little bit more of definitely a workforce housing type play for us. Typically, we're looking for average household medium income to be a little bit higher. But because of the proof of concept on the deal across the street that George had ownership interest in, and seeing the fundamentals of the market slowly changing over time, we definitely had confidence in this area not being it's not a bad area. It's just an area that hasn't been very taken care of. And considering there's 3 assets on the street, 2 of them had already traded, and this was the last one that hadn't traded recently, we knew the market was definitely up and coming, and we would see an improvement in the area. Cody, anything else you want to add to this?
What I'd say to this slide, everybody, this is their buy right criteria right here. This is the first leg of the framework. This is what they're looking for. It's really important for everyone on this call to figure out what your buy right criteria is. What you gotta have your parameters down. Yeah. And they've got their parameters. And when they see a deal from Joe, from Jorge, or from anybody else, bam, this fits my demographics. This fits the population. I like the crime in the market. There's this unemployment, median income, vintage, all of that is already worked out on the front end. So when you can focus on that, and you're underwriting deals, you're going to be able to, it's be a lot easier for you to pull the trigger on a deal.
Gino, and something, Cody, I know you can probably chime in on this, but I think it's really hard in today's market to get every box checked. I think that's just something that's really, really, really important.
You got to be able to solve problems too.
You got to be able to solve problems. That's what we're doing here as real estate investors, right? So, if you've got 5 boxes that you really need checked and 4 of them are checked, or even 3 of them are checked, and you're sort of riding the line, that just means maybe you need to dig a little deeper to see if there's something else here. Because if you're not looking for a way to create value in today's market, you're not going to find value. You're going to have to make it yourself. That's just something I want to make sure I leave with everybody here, that you got to be looking at these things.
But even go back to Joe's deal. If you're going based on your criteria, checks every box probably except for the population, right? It was 50,000.
Mm-hmm.
But would I do his deal every day of the week?
Sure.
Right? Me personally, I'm not telling anyone to do anything, but I'm just saying, me personally, I love the deal. So,
well, it just goes to show you the importance of being present in your market. You can't look at things on paper, and although you have that criterion, it's great, but being present in the market and actually going through and seeing the micro market in the area, it gives you a lot of information about just that area. And anybody knows Houston, especially near the urban core, is a very tough market to figure out because it's street by street. There's no zoning here in Harris County. So you could literally be in a completely different area just going 1 block over. And so it's important that you have that visible presence and understand the lay of the land, so to speak, whenever you're identifying your target markets.
Do you guys have any more slides left here?
Just one more.
One more.
We've got Jake and Gino, so something I know
okay.
we've been kind of alluding to, but
All right.
definitely wanted to highlight you guys. So why Jake and Gino, why this community? We talked about this already, mindset and culture, super important to us. I think when you're considering joining any type of mentorship group, whether it's multifamily or something else, you definitely want to ask questions about culture because you want to make sure you're joining the right community and that you're not surrounding yourself with negative energy, things that could really bring you down. You want to be surrounded by like-minded people and have people that are in the group that have a track record of success. Being able to talk to people that are where you want to be one day is super valuable in joining a group. And we obviously really like the framework that the Jake and Gino community, the Will Better Profits community teaches, which is buy right, finance right, and manage right, and all the boot camps that come along with them that sort of allow you to dive into each one on a one-on-one basis. And then finally, resources. We just want to make sure we highlight the fact that there's a tremendous amount of resources in the groups, stuff that we leverage all the time, not only with people, but tools. And that was really valuable for us when we were getting started on our journey.
I hope you have one more slide where
We do.
where all the people who are good, where they can get in touch with you. Show. Let me see that.
That's
Well, we got this.
appreciate that, guys.
So this is our next to last slide. So what's next for us? We do have another offering coming out here pretty soon. So we're super excited about that. This is sort of our buy box. We're looking for assets in the 20 to 30 million. Our acquisitions that we would like to add 20 to 30 millions of assets under management over the next 12 months. We're obviously always looking at strategic partnerships. We're not trying to do this on our own. So anybody who's interested in partnering with us, we're always excited about that. Our goal is to place $3 to $5 million of equity in the next 12 months as well. And our goal is to be like you guys. We want to be vertically integrated one day. So we're having those conversations now and what that looks like, but just being patient.
That's awesome, dude. Great job.